What's up, everybody? Austin again. Third video of the day. We're covering Apple earnings, Amazon earnings, my initial reaction. I own Amazon. It's my fifth or sixth largest position. If you don't know me, I'm building a $1 million portfolio right here publicly on YouTube and sharing every step of the way. Real quick check in with the portfolio, $35,000 current value. I've put $37,000 in. We're down about $2,000, which is about a 12% loss. We started the portfolio on February 15th, so short term, not concerned with that. Today alone was a great day. We were up 3%, which is about a $1,000 gain. So real quick review, here's those top positions. Snowflake, $3,500, CrowdStrike, $3,400, GitLab, $3,400, Tesla, $3,300, and Amazon, $2,300. Apple posts big beat in 9% revenue pop, authorizes $90 billion buyback. I bet if I looked at Apple, it's probably up or slightly down. I don't own Apple, but sounds like they had a great report. Look, Andy Jassy, Amazon CEO, and a big scary headline. Amazon shares fall on weak forecast, slowest growth since .com bust. Oh, we need a little perspective there, CNBC. Amazon's revenue and the size of the company is, I don't know, 500 times larger than it was during the .com bust. And so, of course, when the company has so much more revenue now than they did before, on a percentage basis, it's going to be the slowest growth since the .com era because it's really hard to keep growing revenue that fast when it's that large. If we looked at the total value number, I would bet that the revenue that Amazon made in this quarter alone was probably more, maybe even 10x more than the entire value of the company back then. I don't have it in front of me, so I might be off on that number. But the point is the amount of revenue they're generating now is so much more than back then that headline is just extremely fear-inducing and misleading. Let's look at Amazon. It looks like it's down 9.6%. So let's jump into what the numbers actually are. Apple looks like they're up about 2% after hours. Apple earned $1.52 on $97.28 billion in revenue, led by strength in the iPhone and an all-time high in services. Awesome. Consensus Wall Street estimates were for $1.43 earnings per share, so they beat that, and $94 billion in sales. They beat that by $3 billion. iPhone was strong, $50 billion in revenue, up from $47.9 a year ago. Mac sales came in at $10 billion, while revenue attributed to the iPad and services division came in at $7.6 and $19.8. Apple has 825 million subscribers, up from 165 million the year prior. That is pretty impressive. Wearable revenue, which includes the Apple Watch and AirPods, came in at $8.8 billion. I think I just lost my AirPods, so I'm helping them grow that revenue, up from 7.8 a year ago. Apple said it would raise its buyback program by $90 billion and boost its quarterly dividend by 5% to 23 cents per share. Pretty awesome quarter from Apple all around, and I am so dumb for not owning Apple, but that's all right. Now let's look at the sad, depressing news that's going to just tear my whole portfolio down tomorrow, and who knows, maybe the rest of the market. Still down 9%. After hours, Amazon posts a net loss of $3.8 billion. Revenue meets expectations at $116.4 billion. They had a Q1 GAAP earnings per share of minus 756, which missed by 1578. That's not as scary as it looks. Their Rivian investment caused a lot of that. And they had revenue of $116.4 billion. That's up 7%, which was in line. Online net stores were $51 billion versus $53 billion last year, so down there, which was kind of expected with the pandemic. Seller services of $25.3 billion versus $23.7 last year. Subscription service of $8.4 billion versus $7.5 billion in Q1. That's great. AWS net sales, which in my opinion is one of the most important aspects of the business, $18.4 billion versus $13.5 in Q1 2021 last year. They, without it in front of me, I'm pretty sure they beat on AWS sales, which is the cloud division, which is really the future of this business. And so that's good news there. For the second quarter, net sales are expected to be between $116 billion and $121 billion versus $125 billion consensus. So that's why we're seeing this drop after hours, or to grow 3 to 7%. Compared with the second quarter of last year. Operating loss is expected to be between $1 billion of loss and $3 billion of income, compared with $7.7 billion in the second quarter of last year. We're going to go to my friend Fast Graphs and figure out why I'm so dumb and I own Amazon instead of Apple, which just goes straight up. Well, The reason is because I feel that moving forward, Amazon is a better opportunity. Two fantastic companies, but I feel Amazon is a better opportunity going forward. If we look at Apple's history, this blue line is its average price to earnings multiple over this period. Let's shorten this period up. We want to get rid of the great financial crisis because that kind of messes up the data. So over this time, since 2009, the average price to earnings ratio for Apple has been 18%, and it's currently trading at about 27. So it's above its average. But their operating earnings growth rate over this time has been 26%. So it's kind of right in line with a PE that's right in line with its earnings growth rate. So I'm not worried that Apple's going to crash or it's extremely overvalued or anything like that necessarily. But when we look, and it's been growing at 26%, and it's forecasted in the future to grow 9%, 7%, and 4%, the earnings growth rate over the next 3 years is expected to be 7% versus, if we remember, it was in the around 25% range. I do have a little concern that it's not going to deserve a price to earnings multiple of 27 or as high as it used to be valued. And so I think there is some risk here in Apple with where it's at. And if we say we think it does stay at a PE of 27 over the next 3 years, then we're looking at a 7% annualized return. That's not great, and there's better opportunities, in my opinion, elsewhere, like Amazon. If it drops, say it drops down to a PE of 21 with earnings growing at 7%, which could be fair, then you're actually looking at a minus 7% total return for about minus 3% a year through September 2024. Now, if we look at Amazon, it's really better to look at Amazon from an operating cash flow perspective. It just gives us a little bit more balanced metric to look at over time. And we can see since 2010, Amazon's traded at a average price to operating cash flow ratio of 26 with an operating cash flow growth rate of 27% per year. Right now it's trading around 25, so right in line. But if we look at the expected operating cash flow growth rate by analysts, the estimated, this is the right side, then even if it just trades, it stays at 25 through December 2024, you're looking at a 146% annualized return. If it drops down to a price operating cash flow of 14.5, you're still looking at a 13% annualized return. And if we want to look at Amazon on a price to sales basis, which also isn't a perfect metric, but we could see that it's right now trading at a blended price to sales ratio of 2.8. You know, that's also pretty much in line with where Amazon has traded on a price to sales basis, really since back in 2009, 2010. We can see, you know, anytime it's at this orange line, it's trading at that normalized price to sales ratio of 2.7. Did dip a little bit, you know, during some rough stretches, but each time it's come up. Got way overvalued, you know, in terms of historicals through, you know, the COVID reaction. And now it's dropped down quite a bit, and even more now, to where even if it just trades in line with its normalized price to sales ratio, you're looking at a 13% annualized return if it's trading at a price to sales ratio of 2.7, which is not astronomical, especially as Amazon transitions to more revenue from AWS, which is higher margin revenue, more advertising revenue, more recurring revenue type business. Not unreasonable to think it would still deserve that same price to sales ratio. But if we go to forecasting, and even if, you know, the price to sales ratio goes down from here through 2024, and it goes down almost 30% to a price to sales ratio of 2, you're still looking at a slightly positive return. So in my opinion, Apple's quarter was obviously a little bit better than Amazon's. Amazon has some challenges. Amazon's not going anywhere. The business, in my opinion, is much more reasonably valued with more of a margin of safety. And I will continue accumulating more shares of Amazon, especially on weakness, because I see no cracks in the business. And it's trading at a very reasonable multiple for the security we have in that business, compared to a lot of stocks out there, and even compared to Apple, in my opinion. Love it if you let me know in the comments. Am I right? Am I wrong? Is Apple the better buy here versus Amazon? Am I a horrible investor? Let me know in the comments, but you can only say mean stuff if you like the video and subscribe.